Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of What are IPOs? A simple guide to initial public offerings and how they work. Taking a company public is a big step with far-reaching implications. Initial public offerings, or IPOs, mark the moment a private company shares its stock with the public for the first time. This process raises capital, increases visibility, and allows early investors to cash out. But how does it really work, and why do companies make this move? In this video, we'll break it all down in simple terms so you can understand the basics of IPOs without the confusion. What is an initial public offering, IPO? An initial public offering, IPO, is a defining moment in a company's journey. It happens when a private company decides to sell its shares to the public for the first time. By doing so, the firm transitions from being privately owned to publicly traded on a stock exchange. This move isn't just about raising money. It opens the door to new opportunities, from increased credibility to attracting more investors. But how does this process unfold, and are there varying ways to go public? Let's break it down. The process of going public. When a company chooses to go public, it follows a specific, detailed path. Here's how the process typically works. Decision to go public. The company evaluates whether going public aligns with its long-term goals. This often includes meetings with stakeholders and senior executives, hiring advisors and underwriters. A team of professionals, including investment bankers, underwriters, and legal experts, is assembled. These advisors guide the company through the IPO process and manage risks. Preparation and documentation. Extensive paperwork, including financial statements and a registration statement, is prepared. This information is submitted to the regulatory authority, like the SEC in the U.S. SEC approval and roadshows. Once the regulatory body reviews and approves the company's submission, the team organizes roadshows. These are presentations to potential investors to generate interest and gauge demand. Pricing the IPO. After understanding market interest, the company sets the initial share price. This price reflects market conditions, company valuation, and investor demand. Listing and trading. Finally, the company's shares are listed on a stock exchange, such as the NYSE or NASDAQ, and public trading begins. From this point, anyone can buy or sell the company's stock. It's a long and complex process, but each step ensures that the company is prepared for life on the public market. Types of IPOs. Not all IPOs follow the same path. Companies can choose from a few different approaches based on their situation and goals. Here are the most common types. Traditional IPOs. This is the standard way of going public. Underwriters, often investment banks, take the lead by helping the company price its shares, market the offering, and sell stock to institutional investors before public trading starts. Direct listings. In a direct listing, a company skips underwriters and sells existing shares directly to the public. This method avoids hefty fees and typically works for companies with strong public recognition, like Spotify or Slack. SPACs, Special Purpose Acquisition Companies. A SPAC is essentially a blank check company. It raises funds through its own IPO to later merge with a private company. This method has gained popularity in recent years because it's often faster and less cumbersome than a traditional IPO. However, it comes with risks, particularly around valuation. Each method has pros and cons. Companies weigh factors like cost, speed, and control when deciding which route suits them best. By understanding the IPO process and the options available, you're better equipped to see how companies take this significant leap. Benefits of going public. Deciding to go public through an IPO is a monumental step for any business. While it requires significant effort and planning, the rewards can be transformative. Companies gain access to fresh capital, greater recognition, and opportunities to reward early stakeholders. Below, we'll explore the main benefits in detail. Access to capital. One of the biggest advantages of going public is access to substantial funding. An IPO allows a company to raise money directly from public investors by selling shares. Unlike private funding, which often involves negotiating with a handful of venture capitalists or institutional investors, public markets open the door to a much broader pool of resources. This influx of capital can fuel expansion, develop new products, or even pay off debt. For businesses looking to scale quickly, it's like switching from a slow drip of funding to full access to a fire hose. This financial boost provides the flexibility needed to pursue big strategic goals without constantly seeking external loans or private investments. Enhanced visibility and prestige. Listing on a public stock exchange doesn't just mean more money, it also elevates a company's profile. IPOs often bring media coverage and investor attention, both of which can raise brand awareness. When a business's stock starts trading, its name often becomes instantly recognizable, not just to investors but also to customers and industry peers. This visibility builds trust. People tend to see publicly traded companies as more credible because they're required to operate transparently and file detailed financial reports. In addition, the prestige of being publicly listed can attract top talent, strengthen partnerships, and improve relationships with suppliers. Liquidity for early investors. For early investors, an IPO represents a chance to convert their equity into cash. Founders, venture capitalists, and even early employees who hold shares can sell their stock once the company goes public. This is often a key milestone for stakeholders who supported the business during its early, riskier stages. Before an IPO, these individuals often hold illiquid investments, essentially locked-in funds that are difficult to sell. But post-IPO, those shares can be traded on the stock market, giving them flexibility and the opportunity to realize significant financial returns. It's a tangible reward for their belief and commitment to the company's vision. Risks and challenges of IPOs. While going public can unlock significant opportunities for a company, it also comes with its share of risks and hurdles. Conducting an IPO isn't a guaranteed success, and the journey requires careful planning, substantial resources, and the ability to adapt to new demands. Let's dive into the core challenges companies face during and after the IPO process. Market volatility. The stock market can be as unpredictable as the weather. External market conditions, such as economic downturns, geopolitical events, or shifts in investor sentiment, can significantly impact an IPO's success. Even if a company is strong and well prepared, timing plays a huge role. For instance, a market that's in decline might make investors hesitant to buy shares, pushing down the IPO price. Conversely, markets that are too euphoric may set unrealistic expectations, leading to volatility post-listing. The tough part? Companies have little control over these external factors. They can't pause a major economic event or fix slowing global growth, but such issues can still dictate how their IPO performs. This is why many companies spend considerable time studying market trends and choosing the right window to launch their IPO. But no matter how carefully a date is chosen, there's always an element of risk when stepping into the public arena. Cost of going public. An IPO isn't just expensive, it requires deep pockets and a willingness to take on significant upfront costs. These expenses can add up quickly, draining resources even before a company sees any real benefits. So, where does all the money go? Underwriting fees. Investment banks typically charge 5-7% of the total IPO proceeds, which can translate into millions. Legal and accounting costs. Complying with regulations and preparing financial statements isn't cheap. Companies must hire experts to review every detail. Marketing and roadshows. Spreading the word about the IPO takes money. Hosting roadshows, creating promotional materials, and engaging with investors all come with a price tag. Beyond this, companies must also consider the long-term costs of compliance, which we'll cover in the next section. For smaller firms or startups, these expenses can be prohibitively high, deterring them from pursuing an IPO altogether. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.